How to weather stock market correction. Stock market is a volatile place. Prices rise and fall, sometimes by large amounts over a short period of time. Periods of marked increase have tended to alternate with cycles of sustained decline in the stock market. Periods of growth have always outweighed periods of decline. If trading and investing were simple, it might be relatively easy for an investor to ride out a market downturn until the next recovery. But, investors need to think about their portfolio. Price declines tend to frighten investors. They end up making poor decisions affecting their financial condition. There are investors who have taken steps to prepare their portfolios for occasional market drops. They are better able to manage their emotions when stock prices fall. How to survive a stock market correction. Examine your portfolio. While the best portfolio designs anticipate all possibilities from the start, you can always improve your planning. When faced with an unexpected market condition, take time to review your portfolio. Here are some of the risks you might face and some ideas for potentially lowering the chances that your portfolio will suffer a significant loss. Overly narrow asset allocation. Allocate part of your portfolio to bonds and treasury bills. When stock prices fall, a rise in your bond or money market investment may help to cushion the fall. Under diversification. Though diversification does not protect an investor from potential loss, holding multiple stocks in different industries will have a limited impact on your portfolio when a stock falls sharply. Downside risk. A 50% drop in the value of a stock can be disastrous to a portfolio. To avoid downside risk, focus on less volatile stocks. Consider looking at issues that pay solid dividends. Market volatility. A long-term investor should not be concerned if the investment fluctuates from one day to the next. You can reduce volatility risk by putting money aside for the next 5 years in a more conservative investment. The risk of liquidity. When an investment is said to have a liquid market, it usually means that you can easily buy or sell a position at or near the most recently reported selling price. When an investment is illiquid, you may be forced to accept a significant premium or discount from the most recent previous price to execute a trade. One measure of liquidity risk is the size of the deviation, another is the potential delay between ordering and executing a trade. A reasonable market decline. It's important to note that price declines are a normal and healthy part of investing in the stock market. Investors who are concerned about this risk should consider strategies to help them limit their overall investment risk. Remember that, despite several down cycles, stock prices have historically risen over longer time periods. Accordion's Business Services can assist you in making informed decisions about your stock market investments.